The capital market is what I can say the intermediary which brings together people who have capital and people who want the capital. It brings them together through certain instruments and their shares, their bonds, which will cover. As Rock Investment Bank, we had the privilege to be a strategic partner in Nabo Capital, where we acquired 60%. And what this means for us is just giving us that investment platform. So if you want advisory services, you come to us. If you want wealth management services, you come to us. And Nabo being a strong established brand, we will have synergies and grow the investment platform. Well, what is the indicator that I need? It's time for me to diversify my sources of capital. First of all, if you have a steady, and you see when I say capital raising, it can be raised in various ways. You can go to the capital markets that we are talking about, and you either do an IPO, which just means you sell your shares to the public. Yeah.
What is the one advice that you feel or you wish that businesses knew before they went into diversifying their capital through the capital markets?
I think for me is investor readiness, and KEPSA has done a lot, and thanks for that work. And I think your advocacy role, you've really played that bit well in even communicating what are the needs of your members to the various stakeholders. We've just come out of the budget season, and I know it's one way, it's one of the ways where you play, say these are what our members are saying, and you present it,
So bull or bear, from if an outsider is trying to understand Kenya's capital market, where would you say you are?
It's bull, without a shadow of doubt. It's
that
bull.
Was very confident.
Yeah. And why am I saying this?
Brought to you by CH Studios, creating content that connects.
Hi, it's good to see you joining yet another conversation. I hope that whatever you do, you're keeping safe and sane, which is very important. Today we are talking about capital markets, and my guest, Eliud Njoroge, FCCM, is going to help us demystify everything that we have known or not known about capital markets in the Kenyan context as well as in the African context. What are those questions that you've been wondering where to put your investments, where to put your money, whether you're a business leader, an investor, or even a young professional? Ama wenye tumezeeka kama sisi, and we still can't figure out capital markets investments. He brings to this conversation over 15 years of experience advising governments, advising investors, advising businesses, and even financial institutions. So he's definitely the right person to have on set today. Eliud, you have an impressive profile, but Najua, I haven't completely said exactly what you do on a day-to-day basis. So if you could introduce yourself.
Thanks, Josephine, for having me. I'm excited to have this conversation. Personally, it's my passion to just communicate about investments, and not just to institutions, but also to individuals. And so thanks for having me. And looking forward to having a great conversation. So who is Eliud? I know you've talked about my profile, over 15 years experience. But I think also Eliud is passionate about, the whole world of investments and what it means even to, as an individual, as a society, as a country, even as a region and the world as a whole. When you think about investments, most people think it's, first of all, you need to have a lot of money, to start something. But I think for me, what I've taken through the years is the discipline and consistency to keep on, whatever amount of money, just, putting it in, in the different places that we'll, later mention in this conversation. And maybe perhaps also something else that I love talking about, and about the whole investment, that it's a process. There's normally the saying that goes, you don't get rich in, you just wake up and you're rich and you're there. No, there's a process. And a good analogy that I always refer to, when you look at first of all, by the way, I'm a sports fanatic. Yeah. And
Which
and
sports exactly?
when I say sports fanatic, it's various sports. And why I think, even when you think about the movies, some of the movies that I feel, really left a mark, apart from the action movies, is, those movies of a team, it's not doing well, then a certain coach comes and after working hard and training, then they win a tournament or something. Those are the movies that used to move me as a kid. And I think where I was drawn to sports is when you think about not just the celebrations, the trophies, the joy that comes at the end, but it's the process. It's the sweat and tears, during practice that, the crowd does not see. It's the near misses. It's the disappointments, and, several examples are running through my mind. I'm thinking of, Arsenal had to wait for 22 years, to win the Premier League. And after near misses, they were even called the next season team, like Netflix, think of even the current NBA champions, New York Knicks. They had to wait for 53 years. And it's not that their team was not good. They were building, getting this player in and out. Back home, we have Sebastian Sawe, the current men's marathon world record holder, running less than 2 hours, 1 hour, 59 minutes, 30 seconds. And an interesting thing, yes, he's been in the athletics field for long, but initially he was a pacemaker. And I think in one of the half marathons that he was running before he broke the record, he was like, why am I pacemaking? Can't I go ahead and win? And actually the guy went on and won, that particular half marathon. Also another story I'm thinking about, the likes of Emmanuel Wanyonyi, the current 800-meter Olympic champion. Very humble beginnings, and right now he's doing well. Maybe lastly, and there are so many of these stories I can share. Lastly, there is a gentleman called Alexander Zverev. He's a German and he plays lawn tennis. He's been trying to win what we call a Grand Slam, and finally this year he did it in the French Open 2026. And why am I sharing these stories? Again, my favorite. There's a team in NBA called Golden State Warriors. Golden State Warriors, maybe one of the people is Steph Curry. And initially it was not a good team, but 2015 they got to the finals and they won. And in 8 years they got in 6 finals and won 4 of them. So it's not just a matter of getting to the top, but also staying at the top. Getting to the top, requires having that hunger. But staying at the top now means reinventing yourself, always rethinking how can I be better. And I guess this is why these stories always, just watching these stories, and I dig deep to know what's their history, how have they been doing. I don't even want to go and talking about the current World Cup. There's so many stories you can talk about, but I think it's the process, when you read about either as an individual athlete or as a team, it's the process that they had to get there. And that's the same process that I keep insisting on when it comes to investing. Yeah.
If anyone had any doubt that you're a sports fanatic, clearly, no more doubts.
Yeah.
But it also sounds like there's personal experience on your end. You didn't just one day wake up and decide to be an advisor in investments, or you didn't just wake up and decide finance is the area that I want to be in. What was your journey? Like the same way you have told the stories of all the other journeys?
So I think my journey started quite early, and I'd give credit to my father, who exposed us to my siblings and I to money quite early, and I think one of the many things that he did is during the Safaricom and Kengen IPO, we were still young, we were still in campus. For the mathematicians, we already have a range of my age, but it's okay. He actually bought us Safaricom and Kengen shares during the IPO. That time, we even didn't have an idea of, what an IPO is, but somehow I'd get drawn to the business section of the newspaper and read what's going on. And also, I think he used to own some shares, and so when he'd send us to go to the post office, some of the letters he'd get, it's actually the dividend checks, and you'd see, oh, this such and company has remembered me. Okay, it's a dividend. Then those days you had to go and bank the check and everything. So he bought those shares for us, Safaricom shares, Kengen shares, and he told us, I'm just buying for you guys to build a base from it. And I think that sparked something in me. And therefore, I was like, yeah, why not? And therefore, using my HELB loan, so I had a HELB loan, and I was being given some pocket money here and there. I think the surplus I used to go and add to, always remember, this is a base, build on it. So I'd buy, after every semester, my HELB loan checks in, I buy one or two things, discretionary spending, and the rest I save. I go and buy shares. So by the time I was leaving campus, I had a pretty good portfolio, if I can say that. Not much, but at least there was something to start with. And that's the most important thing. I think it's start with whatever you have, and always another lesson is always invest in yourself first before you. I know these are cliche. You have to save before you spend, but it's key. Invest in yourself first before you go into discretionary spending.
Does that apply to everyone, no matter what you're having? Because some people are in stages of life where that's not a luxury or an option.
And I know that's a very interesting question. When you think about it, that's where the aspect of budgeting comes in. And you're saying, and maybe sometimes, as you're saying, there's some situations you even try to budget what you have, and the math is not mathing. You get what I'm saying? But I think the thought process is just, if you're in a position to keep something separate for growth, now it will actually, you see Kiswahili. This wahenga told us haba na haba jaza kibaba, but you have to start. So it grows with time. And even if I was to go back to the Bible, it says, if you are faithful with the small thing that you have, even in big things, you'll still, because it's a process, it's a discipline. So you don't wait to have a certain amount X for you to start investing. Yeah.
So listening to your story around campus, kuna kijana anakusikiza saizi anasema, I'm still young, I need to enjoy life. You're there saving your help into into shares when you should be having fun with your other fellow students. What difference does it make later on in life, looking at how yours has turned out?
I think for me, and you see what I did then, it served as a good base for me to build on it, and actually have something to rely on. Yeah. And also now when I started working, I think the discipline was already there in terms of I need to to put something aside. And I think also from, for the parents who are listening, it's good to always, expose your kids and to this thing. If you give him, let's say, 500, tell him no, take 200, the rest put or whatever. But just that, those lessons, because they are key when it comes as you're growing up. Yeah. So this is very important to even that person, that young man who's listening to me in campus. It's never too early to start, and it's never too late to start. If you didn't plant a tree yesterday, the next best time to plant it is today. Yeah, is today. So and it will come to help you, because what you do when you're in campus, when you're enjoying, you'll say, let me enjoy. Yes. And I enjoyed my campus life. I didn't say if I tell stories, I did enjoy. And enjoying is relative.
Yeah.
But I think it's just having that mindset of doing something and keeping something for a rainy day. Yeah. It's a very important mindset, because if you think about it, our savings culture is, as Kenya, even as a nation, I don't have the numbers right now, but it's quite minimal. And you see, the more the savings culture, the savings that you are putting in, it's what now will grow, because whoever you'll give those savings to, be it, and I'll come to them, be it equities, be it stocks, bonds, whatever, they actually use that money to grow the nation, to build infrastructure, to expand companies, and then jobs are created. So I think that savings culture is important, from an individual level to a society level, to a community level, all the way to the national level. Yeah. And it's good thing, even the other day, NSSF, we used to save 200 shillings per month for NSSF. And if you do the math, 200 times 12, around 5,000, then maybe your active years, let's even 40, 5,000 times 40, 200,000, and maybe it takes, times 4, that's 2 million. You see the kind of even figures that you're speaking about, and you want after retirement,
life of working.
And therefore that saving culture, just the fact that, yes, depending, it was increased tier 1, tier 2, but at least it brought some respectable. We used to be the laughing stock in Africa. Yeah. Kenyans are saving this much, but now we can, join the table and have respectable conversation. So these are some of the things we are talking about, even from a national level and from an individual level. Yeah.
Okay. Now let's come back to capital markets. And a lot of us hear and engage about the term capital markets, but I'm not sure how many of us really understand what these are and what they entail, what they mean to me, maybe as an individual, what they mean to a business and even an investor. And I like that you keep giving the national context and what that translates to us as a country. So in the most basic of explanations to anyone who's trying to, break down and understand capital markets.
Capital markets, simply put, is where we have people who have capital or who have funds. So the capital market is what I can say the intermediary, which brings together people who have capital and people who want the capital. It brings them together through certain instruments and their shares, their bonds, which will cover. And what happens, the people who have the capital, they come and they get returns. And the people who want the capital, they also come, they get that money, and they grow their businesses, they expand their businesses. And therefore, the capital markets bring these two guys together. And it's a win-win situation. So you who needs capital, you'll be given the capital, you'll get the capital. There's a certain definitely cost to it. And you who owns the capital, who has the capital, you'll get a good return for your capital instead of your money just sitting on it, or, so the capital market is that intermediary, or is that place where they come together, and they have a conversation and they exchange, and it's a win-win situation. So that's what the capital markets are, simply. And if you think about it, very many things happen in the capital market. Starting with, what I can call, so first of all, capital markets are public, you see, and I want to distinguish them, because if you go and get a loan from a bank, that's a private transaction, but capital markets are public, and therefore, it will be out there, and the fact that they're public, they even, regulated, and that's why we have institutions like, CMA, Nairobi Securities Exchange. And therefore, the various types of, capital markets, you'll hear of shares, and most people think you need to have a lot of money to have shares. But actually, we've seen very good developments in our country to just demystify the whole owning of shares. Something like ZD Trader, where, you just, at the click of your phone, you don't need a broker, you don't need what you call a CDS account. You can just, at the click of a phone, use your M-Pesa balance to buy shares. Yeah. And a share is a part of a company. Yeah. And also something else is another development. You'll find that, a while back, you could only buy shares in batch of hundreds.
Yeah.
But a law was passed recently where you can even buy one share. You can imagine buying, let's say, for example, one Safaricom share. And what does this mean? It means that institutional investor who has lots of money, think of pension funds, and that guy, your ordinary guy on the street, can own the same share. For example, Safaricom, KCB, and other shares. That's a game changer, because then you've broken down the myth that you need to have a lot of money to own that particular shares. I also want to go, there is now shares, it's where you own a company, and there's also now what we call bonds, T-bills and T-bonds. You'll also hear corporate bonds. So T-bills and T-bonds are issued by the government to raise cash, but corporate bonds are issued by individual companies to raise debt. And therefore, corporate bonds and bonds and T-bills are more of debt, which you'll pay. But for shares, now you own the company, and unless you want to sell, you'll actually be getting dividends from it. So basically, that's what capital markets is all about. Yeah.
And just I like that you brought up the issue of accessibility now, and we are seeing NSE also evolving with the needs of the public, and making it accessible and making it more modern, if we are, based on whether it's incorporation of the technology and all that. So it doesn't limit anybody anymore to participate in shareholding of companies by buying shares directly. And I think it's one of the things that have happened with ZD Trader, the launch recently, that has brought up that conversation about accessing shares and how easily it has always been. You are the associate director at Rock Investment Bank, and earlier I was actually trying to, because traditionally for you to buy shares, you already mentioned you needed to go to a broker, or so. For me, trying to understand investment banking and the normal banking, what differentiates you as an investment bank?
Yeah, thank you for that question. And so for as an investment bank, I think, and most people don't understand actually what investment banks do. So it's different from commercial banking. Commercial banking is where you go and, if you have money, you deposit in your bank account, and if you want a loan, you go and request, and you go through the process and you get it, amongst other products. But for investment banking, I think we are looking at there are a couple of things you can think about if you're thinking of investment banking. So the first thing is advisory. And when I say advisory, it can cover a myriad of things. But we are basically advising. Remember my two guys, one who owns capital and the other one who needs capital. So as an investment bank, we're a financial intermediary. We bring these guys together. We marry these guys together, and each gets what he needed. So it can be an individual or an institution who have the capital, and it can also be an individual or a company who wants, or an institution that wants the capital.
Yeah.
And so investment banks bring these two guys together. Yeah. And therefore, advisory, if you think about it, without going into much detail, is just helping these guys, advising these guys, whether you're acting for the guy who's raising the capital, or you're acting for the guy who wants the capital, or rather who owns the capital. And you'll get that by bringing these two guys together. Now that's where you'll get mergers and acquisitions. Yeah, you'll get capital raising mandates. And you see, when I say capital raising, it can be raised in various ways. You can go to the capital markets that we are talking about, and you either do an IPO, which just means you sell your shares to the public. Yeah, you can even do a corporate bond, which means you get money from the public or from the institutions, debt, to fund your expansion of your company, for example. So investment banking, that's one of the key things that it does. And when you think about advisory, at Rock Investment Bank, the advisory division is actually, we have 3 departments under it. We have the public markets, and there we deal with, project finance, infrastructure financing. We have the private sector, and there we deal with corporate finance, mergers and acquisitions. And we have the capital markets, and here we deal with structured finance, pre-listing, preparation, IPOs, and various other things. So also investment banking, there is what we call investments or trading. Yeah. And it's basically where, for you to trade a share, you need to come to a broker who will trade these instruments for you, and then there'll be brokerage charges, and that's how we get our fees. When it comes to advisory, we get our fees either through retainer fees or what we call success-based fees. If we help a company to raise capital, we get a percentage of that, because once the capital is raised, so that's called success-based fees. There's also wealth management. And wealth management, this is where you have your, what we call collective investment schemes. So we have your MMFs, money market funds. You have your, you have your fixed income fund and any other fund that comes there. You also have your special funds, yeah. And I know, you've seen the special funds that have been prominent in Kenya. So there's advisory, there's investments or trading, and then there's the wealth management, or what you call fund management. And recently, as you saw, I think 2-3 days ago, we, as Rock Investment Bank, we had the privilege to be a strategic partner in Nabo Capital, where we acquired 60%. And what this means for us is just giving us that investment platform. So if you want advisory services, you come to us. If you want wealth management services, you come to us. And Nabo being a strong established brand, we will have synergies and grow the investment platform bigger.
Thinking or listening to you makes me feel that you have a very specific clientele. From corporates, I think that you have already covered, whether it's, I'm assuming government institutions as well.
Yeah.
Then we have investors, whether they are national or international, coming in to invest in the Kenyan market. But then, even reading from your company profile, there is a category of affluent individuals. Now, earlier we were laughing about something that I have recently seen, and I want us to get into that. Because when we're talking about affluent individuals, based on this, so it's Kenyans' net worth categories. So affluent here is between 20 million and 100 billion in terms of net worth. Does that qualify to your clientele of affluent individuals, or is that a different category? Or where would I find myself as an individual who wants your engagement as Rock Investment Bank?
Again, Rock Investment Bank, as I said, with the 3 divisions, and we focus on institutional investors for now, yeah. And later we are thinking about how do we engage even. I know we've said affluent, and you've read, a category, or you've put a number to what does it mean to be affluent. And I don't know where that data came from, but
I would also like to know, because I think a lot of us have been lying to ourselves if this is the category.
If that is the category. And I think the message, as Rock, yes, we focus on the institutional investors, but given the fact that we've acquired, or rather we are strategic partners with Nabo Capital, Nabo Capital has also products that are speaking to what we call retail investors. And retail investors is me and you, and maybe the other person on the ordinary people. Retail investors, where you get, there's the entry point is low, and also you don't need as much money for the entry point, and maybe even as top-ups. Yeah. And you'll get that most collective investment schemes, be it money market, fixed income, and the other funds, they actually speaking and targeting to the retail investors. And that's why when I said we want to create an investment platform, we don't want to leave anyone behind. Yeah. So both institutions, both the affluent, and also maybe affluent is not the word. Both institutions and retail investors, institutional investors. Because when you say retail investors, it's not really in the amount of money. It means it's an individual, you and me. But institution, you're coming as an institution or a company, and you'll find in most cases, if not all, institutions come maybe with more. They have more resources than the retail. But also on the flip side, you'll get that. There are 1 or 2 retail investors who have even more resources than institutions. Yeah. So I think it's a myth, but when all is said and done, I think we are looking at both markets, or both categories.
Okay.
Yeah.
So assuming I have, this is equally a masterclass for me. So assuming I'm a retail investor, right now I have 50,000 that I want to invest, either in MMFs or in shares or in bonds, whichever. From an advisory point of view, which option would be most financially sensible for me to make it as an entry point investor?
I think the first thing, even before you go, what do I do with this 50,000, is understanding your risk profile as a person.
How much I'm able to tolerate or willing to tolerate.
Thank you. Because the investments which will preserve your capital, the investments which there's an upside and there's a downside, where you might even lose your capital. So if you put, let's say, 50,000 and buy a certain share X, there's the possibility that, let's say, you bought it at 20 shillings. There's a possibility that share might, in the next 2-3 months, it might go to 25. And there's a possibility that share in the next 2 to 3 months might come down to 15. And what does that mean to your capital? It means you your capital has reduced, or you've gone into losses. Because if you put 50,000 now, if you bought it at 20 and now it's at 15, you see that's a loss. So your risk profile, you need to understand yourself as a risk profile. Are you risk averse? And therefore, if you are risk averse, you need to put your money in instruments that preserve your capital. Yeah. Are you risk neutral? Risk neutral is you're not averse and you're not a risk taker. You're just somewhere in the middle. And there are instruments which speak to that person. They call it a balanced fund, and then if you are a risk taker, now you can go for the where the risk is higher, but the returns also tend to be higher. So I think just understanding your risk profile in the first place is key, even because your risk profile determines where, even as you diversify, where a significant portion of your investment will be. So in this case, you are 50,000. If you are risk averse, you can put it in MMF as you are scouting for opportunities. And MMF is just like as a springboard to other investments. So you look at which stock do you think, and you do your research. One thing I think with the investors, being a savvy investor, you need to understand, what the company is all about. You cannot invest in something that, if I ask you, how do they generate cash? Is it regulated? You have no clue. You only invest in what you can understand. And it's unfortunate, there have been scandals in Kenyans investing in things because of the trend. Such and such a investment is good. You put in, you don't know where the returns are coming from. You don't know what's the underlying asset. You don't know whether it's regulated or not. And, that's just the outcome is premium tiers, unfortunately. And it's sad. And we've seen all these stories in the newspapers and in our media. So I think just understanding the risk profile, and then, what do you want? So ideally as a young investor, because you have time, you can recover, you'll find, you have the appetite to take risk. But you can imagine as a retired person, you want to preserve your capital as you are getting a reasonable return and a regular, a regular income, or a regular share of your capital. So you are preserving your capital. So all this, it depends on your risk profile. Yeah.
There's something I've always wondered, for instance, I can say I'm high risk, but even within the high risk category of investors, you find, for instance, we bought the same shares.
Yeah.
Tomorrow it has gone down. I've panicked. I've withdrawn. But someone who invested the same amount has stomached that and waited a bit longer. Maybe the other day it changes. So what makes a successful investor at the high risk category?
And first of all, it's and I said a couple of things. You need to understand the company. So some of these, you need to understand, where is this share going down? Is it that it's a fundamental business downfall, or the fundamentals of the business are not as solid as they used to be when you bought the shares? Or it's just cyclical. Sometimes, you'll find that some people are selling shares, they are releasing some shares so they can buy another share which they think is much better. But the fundamentals of the shares remain the same. It's still a solid business, And therefore, answering your question, I think, remember when I said it's important to go through the process. And I can tell you, even personally, I've won and I've lost, I've been caught up in chasing trends. Oh, so this and this share is going up. Let's say, a share was 5 shillings, then, in the next 2-3 weeks you get it's 20 shillings. Then because you fear of missing out and chasing, you buy it at 20 shillings and premium tiers loading and therefore when if that train has left the station, don't chase it, and also, as you've said, you've bought a share at X and it has gone down, maybe just not as significantly, just a slight downward trend. Again, it's that ability and discipline to hold back, to know at the end of the day this business is still solid, and I don't go into a panic. And those are some of the mistakes that not even young investors, even people who've
Solid
been there,
ones, yeah.
solid ones, you panic. You're like, "Wait, let me save my capital."
Kitamana.
Yet after another maybe 3 months, 6 months, the thing shoots up, and I think having that ability and discipline to just know this is cyclical. At the end of the day, the company is still solid,
And understanding the macro
understanding the macro
influences that are
influence, what's
happening,
happening, because at times you find depending on what's happening globally. Like, for example, the recent tiff between US and Iran. What happened? Foreign investors panicked. And what happens when during the global macro? So they get out of emerging markets. So the shares they had, they sort of, they want to sell them because now the risk profile of the world is higher. They want to hold to hard currency. So, to hold on to hard currency. So what normally happens when such thing happens, they normally sell, they liquidate their holdings, let's say even in the Nairobi Securities Exchange, and they go to store it maybe somewhere where they call safe havens, in quotes. So when the war erupted, definitely you get now the foreign investors are actually liquidating. What does it mean when there are a lot of shares in the market being sold? Prices do what? They dip. So you, as a savvy investor sitting in anywhere in Kenya, it was a good moment to take these shares at a reasonable price or at a slightly dipping. They didn't dip as such, just slightly. You take hold of them and wait. So when the war ended, or when there was that MOU, they come back. And now when they come back, they want to buy them. So
again.
when demand is higher than supply, what happens?
The price is
Basic
going.
economics, the price goes up. And if you bought them when they were slightly lower, you laugh all the way to the bank quick. So just understanding the fundamentals is important. Secondly, even it's important just having that basic knowledge of reading financial statements. When you hear that results of maybe the banks or insurance companies or whichever company in whatever sector are out, what does it mean? What is their income? What is their profit? What are their assets? Do they have any liabilities? What does it mean? Just having that basic understanding, it's key. And given we live in a world of information, you don't even have to wait for a masterclass by so and so or by company X. No, you can actually do it. If you have a Wi-Fi, you can research and learn the basics. Don't need to be an expert, but just by learning the basics. So when you hear these terms being thrown around, you understand what's happening. Yeah.
So, bull or bear? From if an outsider is trying to understand Kenya's capital market at the moment, where would you say we are?
It's bull. Without a shadow of doubt, it's
That
bull.
was very confident.
And why am I saying this? It's because when you see where we were as a market in the recent past and where we are now, very many things have happened. And one of the things that's coming to mind, it's first of all, there have been 10 new listings in the last 24 months. And this is not just IPOs. The other day, we've just come from KPC IPO. It's even what we call, rates, real estate investment trust. We saw the Triffic recently. We also saw corporate bonds. We've seen the Safaricom bond. We've seen the Safaricom green bond. We've seen the I&M Bank bond. We've seen what we call infrastructure fund. I think Spearhead Infrastructure Fund recently. We've seen even what we call ETFs. The name is escaping me, being listed. And therefore, all this, it means the market is vibrant. Secondly, the last year, the dollar return, the Kenyan Nairobi Securities Exchange was only second to Egypt from a dollar return perspective. I think we returned, the market returned in 2025, 52% on the dollar. What does that mean? If you had invested $1 million, it means at the end of the year, you had 1,552,000. So, no, 1 million and,
That's 52%.
Yeah, 52% plus. Yeah. And 520,000 to be precise, dollars. And that's big. 52% on the dollar. And therefore that is pointing all the way to a bull. Yeah. Also with the new listings, the new developments, and also I think even the whole democratization and opening up of the market, where we've seen after ZD Trader was launched, I think 50 to 60% of the trades were going through ZD Trader, which means participation of not just institutions, but more retail investors who are getting into the market, and many other developments. So I'd go for a bull.
Okay.
Yeah.
Right. You have rightfully said that a lot is happening in the markets, but also a lot is happening at the global level. Every day, I think we're hearing something come up, whether we are talking about at some point investing in technology companies was the newest thing to do. Then we went into gold, I think, something like that. And then now we are talking about digital assets. Like even before you catch a breath on one, or you catch up on one, another one has come up.
Yeah.
So if I'm thinking about the next big investment, whether I'm a retailer or an investor or a corporate investor, what, especially in the age of AI, you never know what's going to be the next one. So what do we need to, what are the, basic fundamentals and the constant ones that at least that can keep your mind on the objective, on the goal?
So I think the basic fundamentals is and I'd mentioned it earlier. So first of all, is whatever I'm investing in regulated? And you see, regulation brings in a form of discipline and expectations to the people who are receiving the capital. Yeah. And it protects you as the investor. And I think having a product, investing in a regulated product, gives you as the investor comfort. Yeah. So is it regulated by CMA or any other, regulator out there? Secondly, do you understand where the returns are coming from? If you are not understanding and you're just following the trend, AI is the next big thing. Hey, blockchain, you are there, but you are really not understanding the fundamentals. If you can't explain to me what you've invested me in 30 seconds to 1 minute, then it means you're investing in the wrong thing, because you don't understand the fundamentals behind this particular investment that you are making. Is it asset-backed? What's the return? What's generating the return? Do we have assets behind it? All those questions are important, are key questions, whether you're an institution or whether you are an institution or an individual. I think also from an AI perspective, and we've seen, stocks or equities related to AI and tech, they've really gone up. Think of NVIDIA, globally, and the other stocks we are looking at. But for me, even I'd go beyond that and look what are the underlying infrastructure that are powering this technology. Think of data centers. Think of like the other day, Safaricom issued I think it was a 20 billion corporate bond, and they were solarizing their stations, and I think funding 5G rollout. So think of the infrastructure behind the whole tech. So there's data centers, there's maybe need for renewable energy because the data centers apparently consume a lot of energy. So also going beyond the trend or the share that everyone is, think about what are the infrastructures behind that particular technology. That is key, and now that's what now savvy investors do, because if this trend is to be sustained, they'll need, for example, data centers. And so who is investing, who's owning these data centers? And you'll find maybe company X, company Y. That is the company to invest in. And therefore thinking, what are we seeing, and also from a trend perspective, what are we seeing? And all this takes it takes reading, it takes the discipline I was talking about, on just having that hunger. Remember when I gave my sports, I said getting to the top requires hunger, but staying there requires humility, reinvention, and discipline. So what gets you to the top most, not necessarily you'll stay there because of what you. So just having that discipline, that hunger of knowing what's happening. And we live in a world of information. Spend 20-30 minutes knowing what's happening in the business world, Kenya, the region, Africa. What does this war mean to me? Energy prices, inflation will go up. It's not just in Kenya, it's everywhere. And then how do I respond?
So knowing your why and then building your knowledge capacity so that
absolutely
you're well covered. And it's always so interesting that some of these rushes have built millionaires, but it has also left a fearful group of people stuck into the unknown. And I don't think I have the capacity to take that kind of risk. And so we find this group that is left, and then that wave goes, has made its millionaires or billionaires, and then the rest of, we are still trying to understand what happened. And our enter into the next one. And I think also this brings me into the other at the policy level, also understanding that, for instance, at the continental stage, we are seeing, and it's still, I don't know whether we are utilizing it to the maximum, the African Continental Free Trade Area, and the potentials that it has to connecting the African markets. And in this case, when we're talking about the capital markets and the role that it has in contributing to bringing that vision of AFCTA into life, do we have, is something happening? And if it is,
I think
it happening right?
It's I've mixed feelings when you talk about Africa, and when you think about it from a trade perspective, we are seeing some resemblance of progress, if I can call it so, because what Africa provides is 1.4 billion, a market of 1.4 billion people, and I think a trade potential of $3.4 trillion or thereabout. And from a trade perspective, we are seeing that intra-African trade. I remember a while back seeing in the news, or was it in the papers, I think our products going to West Africa, or was it Southern Africa? And it's a good thing, and it's bound to increase. And because that intra-African trade will actually means that we are growing each other. We don't have to send our items it means we have the capacity as a region, as Africa, to trade amongst ourselves and grow each other. From a capital markets, I think we've seen the launch of what we call Pan-African payment systems. Something and the vision around, I think it was just reducing the cost of capital flow from one country to the other. And what that means for our capital markets, because I think what Africa gives us, or the door that Africa opens, is making sure that cross-border flows have minimal friction, if not no friction at all. In terms of costs, if I want to invest in a market, if I want to invest in a market in South African stock exchange, do I need really many barriers to go there if I want to invest? And therefore, just that coming together, as much as there'll be independent entities, I think from a capital market perspective, we're looking at cross-border flows between the countries in Africa. And with the launch of this payment system and, Pan-African, I think, settlement system, it's called PAPS, we are seeing that open up because it reduces the flow, the cost of capital flowing from one country to the another, and also the speed, and therefore that's what you want. You want capital to flow in the region, at reduced cost or at minimal cost, but also at the required speed to execute these trades.
Yeah.
So it started, but we are anticipating more progress, and you see that's why we have technology. Maybe that's why technology. How do we leverage on all the technology on our young? Africa is the youngest continent. How do we leverage on that to just open this up and the capital markets? And I'm happy. I think I read somewhere, even ZD Trader, there are some countries which want to adapt that and how they can, not just benchmarking, but integrating and seeing how we can do that trade, and those are some of the conversations that you want, that will open and unlock the cross-border flow of capital. Yeah.
And I feel like, especially for SMEs who are getting into it, it's important to understand what is happening, not just within the Kenyan capital markets, but also in the region. And I'm saying this because I think by not just SMEs, even some established medium and large enterprises, most of them rely on, let's say, bank loans to boost their business. Not a lot of businesses, or maybe you can give us the picture of businesses that are embracing capital markets as an entry point for investing in their businesses, and what are some of those areas that have been overlooked by businesses who are still going for the traditional bank loans as a source of revenue.
We've seen some family offices maybe which, they go to the bank. And I think the question is, at what point what is the indicator that it's time for me to diversify my sources of capital? First of all, if you have a steady, repeatable, revenue generating business, let me call it, every month I'm getting X amount of Kenya shillings. Secondly, the business has reached at a point that, it's not only generating cash flows, a steady amount of cash flows, but it's actually, so it's revenue making, but it's also profit making. Yeah. Which means now you've gotten to a more or less steady state of your business. You've settled down, you've known, the nuances here and there. This is how I'll reduce my costs, this is how I'll get, other income streams. So when you feel your business is in that steady state, you're generating revenue, but also you're controlling your costs to be in a position to make a reasonable amount of profit.
Okay.
Secondly, also, if you feel that the debt that you're taking is really squeezing your margins, you know. It's now, and those are some of the just but few indicators that you actually now need to get more sources of capital. And also maybe for family businesses, you should be ready to, if you are raising equity, you should be ready to cede some, you know, some control, some shares. So
Equities.
and I always tell people it's better to own 50% of 1,000 than owning 100% of 100, you know. Because what this capital will do when you open up, you say, yes, I own this capital 100%, but I own this company 100%, but if I sell a portion of it, let's say even 40% of it, I'll get this capital in, and you know, and this capital, I'll use it to expand my business, and that means more jobs, it means more opportunities, and therefore, that's the role of capital markets, even when it comes to growing the economy, yeah, because you're expanding these businesses, and therefore you'll own a smaller portion but of a bigger cake than owning 100% of a smaller cake. Yeah. And therefore I think those are some of the indicators that you need capital. And you always ask the question, is it debt, is it equity? And I want to keep it simple. I don't want to go to convertible debt, you know. So for debt, that's where we have corporate bonds. We've seen the corporate bond market really coming up, not just even from known institutions, or not just from, you know, well-established institutions, but also from, you know, institutions which are not maybe as known or as public. Yeah. You even have what you call commercial paper, which are short term, maybe 1 year to 2 years, you know, commercial paper, which also it's a good, it can replace your bank loan. And commercial paper, you can either do it privately. That's now where, as Rock, we come in, we can come structure for you something. We know people who own the capital and bring you guys together, or even do a commercial paper publicly. So those are the options we have for debt. On the equity side, we are looking at selling your own shares, either to a strategic investor or a financial investor. And maybe you'll ask me, what's the difference between a strategic and a financial? A financial investor only comes with the money he wants to earn and tells you, quarterly or regularly, I'll want to be seeing a return. But a strategic investor not only comes with the money, but also brings in synergies and maybe synergies and expertise that will help the business grow further. So it not only brings in the capital, but also brings in, you know,
the
other aspects of the business, maybe governance, synergies, you know, and all the expertise that is needed to grow the business. So from an equity side, we are looking at either you sell your shares publicly, what is called IPO, initial public offer, or privately to, you know, what, and this is what private equities do. So when someone tells you he works in private equity, this is what they normally do. And also you can do maybe a rights issue to existing shareholders, and if existing shareholders don't take up the shares, their rights, now you can sell it also to someone else. So in simple, that's how you get to raise capital. And those are the indicators, you know, for a business to say maybe it's time I explore the capital markets.
Just the same way that we discussed my 50,000 earlier, and what to think about first before I decide where to put it. For even as we say businesses now, as a business, I have identified the areas that you have said I'm making profits, and I feel like maybe my margins are a bit squeezed, so I need something more diverse. What is the one advice that you feel or you wish that businesses knew before they went into diversifying their capital through the capital markets?
I think for me is investor readiness. And investor readiness is key because it prepares you and you get to understand what investors or what various types of investors are looking at. And when I say investor readiness, it means how are your books looking like? How's your governance? How are you telling your story, both qualitatively and quantitatively? Qualitatively, you tell it through what we call a financial model. And a financial model, just to keep it simple, is you look at how your company has been performing in the past, let's say 5 years, how you are performing currently, and then using that and a set of assumptions, you project into the future, say another 5 years into the future. And that's a financial model in simple terms. And the key thing about a financial model, your assumptions need to be solid. You cannot say, let's say in the past, your revenue year on year has been growing by an average of 10%. And then you say you project your revenues will be growing year on year by 30%. You need to give us a good reason why it's jumping from 10% to 30%.
What are the assumptions?
Yeah, what are the assumptions underlying that particular jump in revenue? Maybe you are assuming new capital came in and therefore you'll have more revenue streams or you'll have more products, but they need to be solid assumptions. So that one, you're telling your story quantitatively. Qualitatively, we tell our story through either what we call a pitch deck or an information memorandum. And an information memorandum, you're just saying, this is my vision, this is my mission, this is the problem that I'm solving, these are my company highlights, this is where we've come from, my journey, over, let's say, 5-10 years, this is where I'm coming from, and this is where I'm going. This is the market opportunity that I'm looking at, and this is what I want to address. So all those things, part of your financial model, quantitatively, you will also bring a summary. This is where I was from a numbers perspective, and this is where I want to go. Yeah. And also, who are my management? Who's my management? What are their skills? Are they experienced? So from a governance perspective, you're also, and then also, as you're telling your story, there's always the downside and the upside. So don't always tell the good side. Say, these are my risks, but don't stop there. Tell me, yes, these are my risks, but this is how I'm mitigating them.
You're already taking action.
You're already taking action. So when you combine these two, they tell the whole story.
It's possible to, is it possible for a business to be making this presentation and they are so good at the qualitative aspect of their engagement with a potential investor, but they don't go through because of the quantitative. They don't have the numbers right. They don't have the assumptions right. And what are some, what do you have a case that you have seen and you just wish they knew? I just wish that they took the time to understand.
Yeah, I've seen several cases where during the initial pitching, you find that a company is really, the story makes sense, and it's something an investor or a potential investor would want to look into and invest in, and he does this on a high level, and the initial engagement is good. However, when it comes now to looking at the details, you find that the story that he told, the entrepreneur told, or the company told, is not consistent with what you're seeing on the ground. The numbers do not look as flowery as they sounded, and maybe even the margins, maybe there was a one-off revenue item that really padded the numbers, and therefore when you remove it, what we call normalization of, in a normal setting, what the business will look like, it becomes less attractive than what was initially presented. And that has really, broken down deals or that has really made the deal not to progress. So at due diligence stage, that's when you get to appreciate, and you can tell someone who was investor ready. Yeah. And I know there are certain programs, even previously I used to, to work for an investor readiness program for manufacturing entities. And we used to, help people in just being investor readiness, both qualitatively and quantitatively, so that when that potential investor is coming, this guy is ready and knows even not just the numbers, but also how to tell his story, how to present, how to pitch. Yeah. And also ensuring that whatever story he's telling on these two documents, it's consistent with what is in the underlying numbers and the underlying documents. So those are deal breakers, and we've seen them, I've experienced them, and it's very unfortunate seeing that inconsistency. And therefore, because even as you're investing as a potential investor, there's a certain chemistry and there's a certain vibe you need to see from you, and therefore that inconsistency, starts, sowing seeds of doubt. And not as, trustworthy.
Yeah. That brings me to the role of business member organizations like KEPSA. I know KEPSA has been conducting a lot of investor readiness programs, but mostly focused on the SMEs. I feel it's something that also needs to be elevated to larger corporations, and businesses are all at different levels. But I don't think investor readiness needs to end at the entry point. It's something that you need, the way you say, keep learning, keep improving, keep identifying which gaps that you have that can make the next investor pitch better than the others, and could open up to bringing that impactful change to the business. You mentioned about increasing employment, job creations, and also, actually changing livelihoods, And I don't know what other, you're a member of KEPSA,
Yes.
so what other areas that you feel BMOs and private sector organizations like KEPSA then can help, whether it's creating awareness and making this something that is more accessible. I feel like people need to know more.
And yeah, KEPSA has done a lot, and thanks for that work. And I think your advocacy role, you've really played that bit well in even communicating what are the needs of your members to the various stakeholders. We've just come out of the budget season, and I know it's one way, it's one of the ways where you play, say these are what our members are saying, and you present it. So there's advocacy, but also, as you said, you've been holding SME investor readiness, and maybe these ones need to be either increased or even the depth. Maybe not just 1 day, 2 day conference, where there's so overload of information. Sometimes maybe they're thinking, okay, what do I start? What do I end? What do I need to do? What do I begin with? Just having sort of a regular cadence of disseminating this information. Because I think that can make a difference. Because at times, and conferences are good. I'm not saying they're not good. It's just, are there other innovative ways of disseminating this information to the people who need it? And I know, webinars and everything, just seeing, and I think measuring the impact, because it's not just maybe, we've done SME conferences. No. What is the impact? Do you go and get maybe feedback from this, and then you act on that feedback? I think also one thing, and I know it's either in the works or it's already happened, it's just bringing all stakeholders together, bringing these financial intermediaries like Rock Investment Bank, and telling them these guys need capital. Are they the first? Are they investor ready? What do we do? Understanding the stage of each business. Let's say top 20, top 50, or whatever. Bringing them in a room, saying these financial intermediaries, ask them questions. Do we have capital providers? But before being capital providers, are you ready as a business? What do we do to get there? And then so that convening, because amongst your members you have so many, you have all these groups of people, that you have people who need the capital, you have people who own the capital, you have the financial intermediaries. Bring them together, let them talk, in a formalized way, and understand each other. What are your needs? How can we help each other? And therefore, we get even to more value from being a member of KEPSA. Yeah. So that convening, so there's the advocacy, there's the convening, and then there's also now those investor readiness or conferences to either a particular set, as you said, SME, or even sector specific. Yeah. There are programs which focus on specific sectors, whether it's manufacturing, whether it's financial sector, and just bring them in the room and hearing them out and knowing how to deal, because each sector has its own specific challenges and nuances which need to be addressed.
Yeah. We need to come to the end of the conversation, but there's something that we discussed earlier about from a liquidity point of view. And you mentioned something very interesting. Like, for instance, if I am 27 years old today, I need to make sure that 27% of my net worth is liquid. Liquid means that I can easily access it in case of an emergency. I just, because that was the first time I'm hearing that, and I found it to be very interesting, and maybe the audience will also find it interesting to understand, because sometimes we just hear, or the most common one is, I need to survive for 6 months without lowering my lifestyle capacity.
And it's interesting. You see, as we advance in age, some of us advance in age, we don't grow old. So as we advance in age, I think you find that you want, or rather your needs in terms of just having your liquidity, it's important. And therefore, when you look at your assets, which form your net worth are your assets less your liabilities, you get your net worth. When you look at your net worth, you need to think about from my assets, from the various kind of assets that I possess, how fast can I convert them into liquid cash for my needs. It does not have to be an emergency need, but also my discretionary day-to-day spending. And that balance is important, because you'll find, sometimes you have assets. There are some people who are asset rich but cash poor.
Yeah.
And it's a very unfortunate situation to be in, because some seasons in life come and you really want the cash, but and converting some of these assets, for example, land or maybe a house, it's difficult. And therefore, I think that balance of, you don't want to be asset rich but cash poor. Yeah, you want to have a balance where when you need to access the cash for whatever reason, emergency, medical bills, think about it, your retirement, you can do this quickly and in good time to be able to address that particular need. So I think the rule of thumb is, as you said, if you're 27 years, at least 27% of your assets or of your portfolio should be liquid. And the more you advance in age, the more liquidity
you require.
You require. So I know some You know, some people will ask, what about if I'm 1 or 2 years? And I'll tell them that's their math to do. But at least I'm not saying now when you're 100 years, you're 100% liquid and you know, but I think the thought process is the more you advance in age, at least you should have a significant portion of your wealth as either what you call liquid or near liquid. Yes, that you can quickly convert into cash, as even you are still keeping your not so liquid assets. Yeah.
Oh, we have a lot of work to do for, for most of
No,
us.
as I always say, if you didn't plant a tree yesterday, the next best time is today. So you're never too young to invest. You're never too old to invest.
Yeah. And if I wanted to become more aware about my financial situation, which book or tool would you recommend that I get started on?
I think I know there's a book. It's called The Psychology of Money. A very interesting book. And also, so there's The Psychology of Money, but also one that stood out for me is The Shoe Dog by Phil Knight. And I think for me, what I got from that book, it's the process of being. Phil Knight is the founder of Nike. And that story just stood out. Before Nike became the Nike that we know today, it's the process of getting there. You know, hawking shoes, going to China to get the least cost, I don't know what. Just that process and the sweat and tears when people, you know, right now will celebrate Nike, yeah, it's a good brand, but the journey to get there. Remember my initial, when you talked about the sports, the process, disappointments, the near misses, the deal that you did not close just when you know you were about to close it. You know, it made me understand the process, and once you understand the process, you'll be grounded. You know that. You know, you won't start investing today and you expect
miracles
to happen and tomorrow you're a millionaire and billionaire. No, it's that process. And the earlier you start, the better. Because you learn your lessons early, you'll get the premium tiers early, but you pick those lessons and you move forward. So I think for me, the Shoe Dog just, you know, it brings out the concept of it's a process to get there. You know, this guy started was it in the early 80s or late 70s? And, you know, he became known maybe in the mid 90s when the Air Jordan came out. So it really made me, you know, say it takes time. There's a process, you know. So I think even to the younger generation, it's to appreciate that process. If you've not gone through the process, even remember I said you need hunger to get to the top.
Yes.
But when you get to the top, you need discipline, you need humility and reinvention to stay at the top. So, and you cannot do that if you've not gone through the process. Yeah.
Okay. To be honest, I was very scared and pessimistic when we were starting this conversation. Reason being, I knew like there's going to be a lot of, this was much about the audience as much as it was about me, the psychology of money, the trying to figure, where am I? When you say this point, where am I? When you say this point, unajua inakukata tu kienda. But I must say that it's been quite worth it, learning and listening and trying to understand. A lot still to go, so we'll have a lot of side chats. And for those who are also interested, whether it's from a business perspective or from a retail investor perspective, I'm sure that Eliud is also willing and available to take on that journey. As your last final is a question on what is exciting you the most about the capital markets as we end this conversation?
I think for me, what's exciting me the most, it's the opportunities that are being presented by the various legislations that have been assented. When you think of, and I'll touch maybe on, let's say 3 to 4. The first one, when you think of government, the GOE Act, and what the GOE Act is saying is like these entities owned by the government or a quasi-government, we need to, repackage them and support them to be revenue-generating entities. And we've seen, KPC, which was a strategic asset. It's one of, the good assets, one of the many good assets that a government owned. It was sold, and it came to the market through an IPO. It raised 106 billion, and this is just a tip of the iceberg. There are many more. So what does that mean for you and me and the investors out there? Or, it means then opportunities are being opened up in terms of just owning these strategic national assets. If you wake up and you are an owner of KPC, it's a strategic asset. You're proud, and it's bound. The thought process, it's let's sell it to the public and the other institutional investors. So that GOE Act is it's eye opening. The other one, when you think about it, it's even what I'd call Virtual Asset Service Providers Act, and you're just saying, how do we convert these real assets into virtual assets, what we call tokenization. And therefore, we are taking advantage of the technology and AI and blockchain and everything. And therefore, this means even in terms of my asset classes, they are being increased. So I don't just have to think of shares or bonds or MMF, but I can invest in digital assets and opening up the space more. When you think of even an act like the NIF Act, National Infrastructure Fund, and what is the spirit behind the National Infrastructure Fund? We are saying from the GOEs that we liquidate, we'll put this money into a fund. And when you think about it, in the recent past, our infrastructure is either funded through debt or tax money. So we want to come up with a way which is non-tax and non-debt to actually drive the development of our infrastructure. And that's where the National Infrastructure Fund comes in. And you can imagine the 106 billion that was gotten from Kenya Pipeline was put in the NIF fund. The 240 or so billion from the recent Safaricom transaction was put in the NIF fund. Then that brings us to 350 billion. We need maybe another 150 billion. And, we have a seed fund of 500 billion. And then after that, we can, what we call crowding in this 500 billion, 10x. And without knowing, we have 5 trillion of resources for our infrastructure.
Yeah.
So we have raised resources in a non-tax way. I don't need to increase your VAT or your payee, and also I don't need to take more debt, either locally or internationally, to build my infrastructure. And you see, this infrastructure is the one which will bring development and the nation grows. So these are very, what I can call, they're very, the legislations are very
supportive.
They're very supportive of the capital markets, because all these things will happen through the capital markets. Think of the last one, finally, PPP Act. Yeah. And what you're saying, it's public-private, partnerships, where we use private capital and the public capital, they come together and they develop some of these businesses or infrastructure that will, grow the nation. So I think it's very, and also when you think about the democratization of the market, where now I don't have to buy 100 shares. Wherever I'm seated, whether in my sitting room, at the playground, I can access and buy shares using my phone. That's a big thing. So it's exciting.
It's quite exciting. Okay.
Yeah.
I've been trying to avoid eye contact. I know my time is up. Thank you to the production team for being patient with us, because this conversation, actually, I think we can go on and on and on.
Yeah,
There's quite a lot to share about investments and ready. Now, guys, I have to go make my 36%. If you know, you know. I've been your host, Josephine Wawira. This is an industry insight conversation by the Kenya Private Sector Alliance in partnership with CH Studios. And they say, creating content that connects.
Brought to you by CH Studios, creating content that connects.